Let me welcome all of you this morning to the Peterson Institute. Our audience is a little late arriving today on this cold pre-Christmas morning, so we will know the audience will be growing in size, but we should go ahead and get started. This is a very special event. We co-host it with our colleagues from the Italian Embassy. Ambassador Claudio Bisogniero is here. I'm delighted to welcome him and thank him for coming. He told me he has to leave us in a little bit because he organized a lunch today for all 28 EU ambassadors with Secretary Kerry. So he has to attend to those high priority duties. We congratulate him on that and thank him for being here with us and for his team who was so helpful in organizing today's event. Italy, of course, is now the president of the European Council, and in that role is, of course, playing a very active role in discussing and trying to resolve all of the issues we talk about today. As all of you know, the euro has been a constant theme and priority and focus here at the Institute. In fact, in a way, this is our third conference reviewing the history of the euro. In 2004, we had a conference on the euro at 5. In 2009, we had a conference on the euro at 10. We haven't put it that way today, but this is, in a way, the euro at 15. As Jacob was commenting to me last night, the euro has had quite a turbulent early adolescence as it has moved from years 10 to 15, not unlike others in early years of adolescence. And so today we review a good deal of that, ask what has happened, where things stand, and where we go from here. As I say, we're delighted to have worked with a number of colleagues from both the Italian presidency and elsewhere in Europe, the IMF, and other key players in this whole drama to analyze the situation today and talk about restoring sustainable growth and job creation in Europe. Before I turn the first panel over to Jacob Kierkegaard, I simply want to give a short advertisement for the Institute. In light of yesterday's announcements about Cuba, I call your attention to a book we published 6 months ago called Economic Normalization with Cuba, which, with our usual prescience, postulated that at some point there would be political normalization, and when and if that happened, here's what to do on the economic side. So those of you who are interested in that issue have a text and a blueprint ready for you. You can pick up and use at any time, and I could not fail to mention that with this opportunity today. But with no further ado, back to Europe and the euro. Jacob, bring your panel to the forefront. We look forward to an active and lively day on this topic.
Well, thank you very much, Fred. Well, no, it's my pleasure to chair the first panel at this conference, which is going to be about the macro position or the macro response that Europe needs now. And in that title of the panel is, of course, that the current macroeconomic situation in Europe is completely unsatisfactory. So what we have tried to do is to put together a panel which hopefully will have some, in the eyes of some maybe, even radical solutions for what could and should be done in the field of macroeconomics in Europe right now. Because there's a number of PowerPoint presentations at this one, I'm going to ask the speakers to come up one by one, and then once everyone has presented, we will all ascend to the podium for Q&A. We're going to have the speakers in alphabetical order. And with 4 speakers and about an hour and a half, we have somewhere around 12, maybe 15 minutes for introductory remark for each speaker. And without further ado, Mr. Balassone from the Bank of Italy.
Thank you. Thank you. It's quite a challenge to have radical solutions from the central bank to this kind of issues. Anyway, I'll try to live up to the expectation, although I promise I will not be radical. Let me start by briefly summarizing the macroeconomic developments, the most recent ones in the area. economic recovery in the area is at best hesitant, and weakness is no longer confined to the so-called stressed countries. At the beginning of 2012, GDP growth was 0.6 percentage point lower in the stressed countries compared to the average of the area. Last quarter, the relationship was inverted. Growth was actually higher in the stressed countries. With ongoing geopolitical tensions, also exports are losing momentum while internal domestic demand is dragging mainly because of investment. And over the last few months, also confidence indicators started weakening. Since autumn 2013, inflation has been declining faster than expected. In November, headline inflation was 0.3%, and core inflation was 0.7%. From the chart, you can see that it is not just energy prices that are driving these developments. It's also non-energy industry goods and services. The decline in inflation is indeed a broad-based phenomenon. Now there are only 2 out of 18 countries with a reading above 1%, and inflation is negative in 2 countries. More worryingly, perhaps, expectations have also been falling, and currently 1 and 2 year ahead expectations are below 1%, and they only return in line with price stability at horizons as far as 2023. This difficult situation is compounded by persistent fragmentation of financial markets along national lines. Although this fragmentation has been reducing, and since mid-2012, sovereign spreads have been declining, fragmentation is still persistent and present on the financial markets, as is shown by the differential in borrowing costs for firms across European countries. This is so even though the reduction in official rates has indeed impacted market rates, and even though the speed at which credit is contracting has been slowing down. So this is the macro picture. What has been the policy response? The response of monetary policy has been indeed wide-ranging. Policy rates have been cut repeatedly and are now close to the zero lower bound. And more recently, 2 asset purchase programs have been launched concerning both ABS and covered bonds. Together with the targeted longer-term refinancing operations, these moves are clearly in the direction of restoring the transmission mechanism of monetary policy and of supporting the provision of credit to the economy. It is indeed too early to judge the result of these policies. The reading of the last refinancing operation carried out last week is indeed mixed, and the result is probably in line, best seen as being in line with a scenario of weak demand for credit. But some positive results have already been obtained. Since May, when the ECB announced the intention to provide further accommodation, the implied yields on 3 months Euribor futures have been declining by about 20 to 30 basis points for horizons up to the end of 2015, and even more at longer maturities. Also, the euro depreciated by 11% vis-à-vis the US dollar, and by 5% in nominal terms. But monetary policy alone is not sufficient. It cannot revive growth if the underlying problems in the area are not solved, both at the European level and at the national level. On the one hand, the disappointing macroeconomic performance of the area and of some countries within the area reflects structural competitiveness issues that call for structural reforms. On the other hand, it also reflects the extreme weakness of the domestic demand. As noted by President Draghi last August, since 2010, the euro area has suffered from fiscal policy being less effective and available, especially compared to other large advanced economies. Now, during the most acute phase of the crisis, fiscal consolidation was indeed necessary in some countries, both to reassure the markets and to bolster the confidence among member states of the area. Ultimately, to reassure everybody of the capability of the euro area to hold up in a situation where the central bank could not act as a financial backstop for government. But even today, after the deep reforms that we introduced into European governance, after all the structural and fiscal measures that have been taken at the national level, after all the actions of the euro system, all of which has brought the yield differential vis-à-vis the German bund more in line with economic fundamentals of the member states, even today, the aggregate fiscal stance of the area is not really in line with the prevailing macroeconomic conditions. It is expected to be basically neutral this year and the next. Now, structural reforms can indeed affect growth significantly. Available model-based estimates for Italy, for instance, set their impact on the GDP level at somewhere between 4 and 7%. But structural reforms take time to implement and to bear fruit. And the same estimation available set the horizon for this effect to be fully deployed somewhere between 5 and 10 years. In the short term, structural reforms can in fact be costly, both in terms of public finances and employment. And they can paradoxically add to the deflationary pressures. So there is need to support them with some action on the demand side. The need to resolve the asymmetry between a single monetary policy and the plurality of national budgets is by now well recognized. But I think we cannot really wait the time it will take to develop a common fiscal capacity for the area. Last June, the European Council emphasized the importance of making the best use of the flexibility that is already inbuilt in the Stability and Growth Pact. European rules do allow for temporary deviations from budgetary objectives in case of events beyond the control of the member states or in severe recessions. And I think these conditions are now prevailing in a number of euro area countries. Failing to recognize this situation and opting for a blind implementation of the rules could indeed be counterproductive. Let me give you an example with reference to Italy. As you know, Italy is at risk of breaching the fiscal rules because, the European fiscal rules, because its debt to GDP ratio is projected to increase next year. Now, suppose that an additional fiscal effort was requested of Italy to reduce this projected rise in the debt to GDP ratio. Well, if you use standard values of the multiplier, fiscal multiplier, it's easy to show that such a move would indeed most likely result in an increase of the debt to GDP ratio in the short term for next year. Moreover, this policy would likely keep Italy in recession also next year. So where does this all leave us? Do we need pooled resources in order to implement a coordinated European fiscal action in support of demand? I think this is not necessary. I think that such a pan-European fiscal action can be implemented just by giving the proper interpretation of the current fiscal rules. Of course, the action should be accompanied by a reinforced commitment by member states to structural reforms where they are necessary, because this would be the necessary condition for the demand push to be to positively affect also market expectations and confidence. A coordinated response to the recession would also lessen the potential for adverse reactions by the market participant to isolated fiscal expansions by individual countries, especially countries that have less fiscal space. Recently, we had two important positive developments, I think. The first one is the postponement of the decision by the European Commission about the budget plans of Italy and other countries. And the second one is the announcement of the investment plan by the President of the Commission. However, on the one hand, a waiver to slow down fiscal consolidation in a few countries may be not enough to sustain growth, especially if it is going to be short-lived. In this respect, it is somewhat heartening the fact that the postponement of the decision concerning Italy and France was related to, let's say, a wait-and-see strategy towards the implementation of structural reforms in those two countries. On the other hand, the investment plan has been already criticized both for its relatively small size and for the lack of fresh financial resources. I think that all sources of financing should be tapped in order to ensure that this plan reaches its critical mass, the critical mass necessary to support activity in the area. And this should include also, beyond the Union's budget, the European Investment Bank and the private market resources. This should also include national member states' budgets. Equally important, I think we must avoid the risk that the implementation of new projects, which is a lengthy process by its nature, remains entangled in difficulties with the activations of new institutions and procedures, which I believe is one of the main risks that this plan, which has been recently announced, is running into. Thank you.
Well, thank you very much, Fabrizio. I'd like to now ask, assuming we can get Jörg's PowerPoint up here, which should be coming here. Jörg Dekkersin from the IMF.
Thank you very much to the organizers for inviting me. I must say I do agree with a lot that Fabrizio said. And so what I propose to do here is I'll pick up some of the elements and contrast Europe a little bit with what's going on in the US, and then raise a number of questions at the end, which I will not answer, but we can discuss later. So first, just to fix your thoughts a little bit, what is in the forecast right now? We'll go a little bit over the short term and then over the medium term. In the short term, we, like many others, you can see this in the blue bars, had growth pinned between 0.5% and 1% in 2014 and 15, and then accelerating to around 1.5% in 15 and 16. So from under 1 to around 1.5 in 15 and 16. That was in October. But sorry, and that's not the blue bar, actually. That's the blue bar plus the empty part above the blue bar. The empty part is what the ECB has taken away from its forecast now. So if you want to have something more recent, now the recent forecast for 2015 is no longer, the ones that you see out there are no longer in the 1.5% range, but in the 1% range. And that is where the ECB is. We will come out with a new forecast in January, but it makes for a pretty bad year, 2015, if you take the ECB forecast as your baseline. Still, also the ECB then sees again an acceleration in growth to around 1.5% in 2016. The red bar is US growth. It looks much better. So what's going on? A key issue, Fabrizio mentioned this, is low investment. And the investment recovery has not only lagged in the periphery of the euro area, it has also lagged in Germany. You can see this here. It shows you on the left-hand side growth and investment in the 4 quarters through 2014 Q3. In the US, this has been almost 8%. In Germany, around 3%. And in the euro area, less than 1%. So when you look at the right-hand side, you see the differences that small and medium-sized enterprises pay on their loans within the euro area. You can see that the German small and medium-sized enterprises, you see it in the black line, they are paying around 2.5%, while their counterparts, Italy and Spain, are paying between 4 and 5%. But that's not the whole story behind the weak investment in the euro area. As I just said, investment is even weak in Germany, right? So there is more than the fragmentation in credit markets behind this. Fabrizio has already spoken about inflation, so I'm not going to go over this. Instead, I want to just think a little bit about what's going on in Europe. And part of the narrative has been that Europe has gone through an appreciable amount of fiscal tightening and that the fiscal tightening has held back growth. So let's look at the left-hand side of this chart here. You see the pace of fiscal consolidation calculated as the increase in the structural general government balance. So you strip out the cyclical movements, and then you ask yourself, to what extent has fiscal policy tightened in the euro area and the US? So the euro area is shown in blue, and the US is shown in red. And what you see there is actually that fiscal tightening has been larger in the US. That's number one. So again, there must be other stories ongoing in Europe than just fiscal. And second, what you also see is that in the euro area, the pace of fiscal tightening has diminished appreciably from around 1% in 2013 to almost nil in 14, and very little is expected in 15. And yet, yes, this has been enough to move Europe out of recession into a low growth trajectory, but it hasn't really propelled Europe anywhere near to the growth rates that you would expect after such a deep recession. So then let's look at the other part of macroeconomic policies, and that is the central bank. Both the US and Europe are at a zero lower bound. So another indicator then is the size of the balance sheet. And it used to be that the balance sheet of the Fed was appreciably smaller than the balance sheet of the ECB before the crisis, but that has now changed. And importantly, if you judge the monetary policy stance by the size of the balance sheet, it has been tightening over the last year, appreciably so, notwithstanding the recent moves towards the TLTROs. So maybe on the monetary policy front, there hasn't been enough support. I mean, inflation numbers would suggest the same thing, and this probably could make quite a difference if it was more expansionary. Okay. We talked a little bit about where the forecasts were. I said that in our real forecast for 2015, we had back in October about 1.5% growth. In the meantime, many developments have been worse than we expected. In the meantime, in their December forecast for 2015, the ECB is only expecting 1% growth. But right around the time when the ECB made its forecast, and after we had long closed hours, you had a couple of new developments, which I want to highlight here. On the left-hand side, you had the change in the oil price. The red dotted line, you see the oil price that underlay our October WEO forecast. And then, we have just circulated new assumptions about 2 weeks ago, but since then, things have fallen further. So you have, relative to the WEO, like a drop in oil prices of, between 30 and 40%. And that is going to deliver some stimulus to Europe. The question is, of course, what is behind, the extent of the stimulus is a function of what is behind the drop in oil prices, right? If the drop in oil prices reflects weaker global demand, then it's a bad news story for Europe. If it largely a bad news story. If it reflects, however, greater global oil supply, then it is a good news story for Europe. Now, our view is that the drop in oil prices mainly reflects better supply conditions, more supply in key countries in the Middle East, and as well as the shale oil that has come on taps. It has changed the market. And so, in principle, this should deliver a stimulus to the European economy. We estimate, it could be on the order of, tentatively, between 0.2 and 0.4% of GDP, depending on which country, and to what extent it is supply rather than demand driven. And these are still, calculations are very preliminary, and that we are still in the process of refining. On the right-hand side, you see developments in the exchange rates. There's been a lot of attention spent on the weakening of the exchange rate relative to the dollar, but in nominal effective terms, it's not that much. I mean, you know, it's not going to deliver a big stimulus. In the meantime, you've had the yen depreciating, and a number of emerging market economies also had their currencies depreciate. So in nominal effective terms, it's not that much. So there's been some bad news recently that Fabrizio has shown to you in various confidence indicators. There's been good news in terms of, you know, better oil supply. So where this is going to lead us with respect to our forecast, you will see in January. Here what I propose is for you to look a little bit at what do the markets actually think about long-term prospects in Europe. On the left-hand side, I mean, one way to gauge that, to gauge those prospects is to simply look at what do the bond markets tell you, right? So you just plot the 10-year government bond rate. And unfortunately, for some reason, the Japanese bond rate is not showing very clearly, but it is a line that hovers between 1% and 2% basically. And if you look at the European 10-year bond rate, which is in blue, and the US bond rate in red, then you will see that they have been moving together for, you know, a good amount of time. You know, sometimes they are not moving together, but most of the time they move together. But something really has happened lately, which is a sharp drop in the German bond rate. The Bund is now at 0.6%, very close to the rate of the JGBs, you know, and certainly well within the range of, or below the range that the JGB has covered over the last 10 years. So it would tell you that the bond markets are taking a pretty dim view about medium-term growth prospects in Europe. And the right-hand side, you can decompose what has happened, the differential, right, that has opened up between the US. You can decompose it into differences in inflation expectations and differences in real growth rates, right? And, you know, the real growth rate, you know, you can take a proxy for it, you know, with the real interest rate differential. And what you can see is that lately that real interest rate differential between the US and Europe has opened up. So, I mean, markets are thinking growth prospects in Europe are not particularly good. So then let's look a little further. This is our forecast now over in per capita terms, so growth in real GDP per capita from the wheel over 10-year periods, over the 90s, the 2000s, and the 2010s. And what you see there is, you know, typically in per capita terms, growth rates in the euro area and the US have been very, very similar, right? But what's now in the numbers for the 2010s is something very, very different. And the gap that is open is massive, you know, by the standards of the growth rates that we have seen in the past and that we can expect to see in the future. So it's a really worrying picture. And, you know, that assumes that our forecasts actually pan out. So why is that so? I mean, I want to raise there are three possibilities. Why is this medium-term growth gap opening up relative to the US suddenly, right? We haven't seen it in the past. We see it over the next 10 years. Is it because Europe has particular structural rigidities? Is it because Europe doesn't have the right macro policies? Or is it because of monetary union? Now, to the extent we believe that policies have contributed to this growth gap, and why has that been so? Do countries have different diagnoses of the problems that ail Europe and therefore cannot agree? Is it that countries are fighting over a given share in the pie, following their own self-interests, right? And that therefore we are not getting to the right policies, or are there just simple coordination failures at play? I think if we want to move, if we economists want to move forward the policy debate in Europe, we may have to go back to the first bullet and address that. I mean, it strikes me that there are clearly different diagnoses of the problem held in different places in Europe. And so really, I mean, that is where we economists are challenged. I mean, that's what the profession has taught us to do, is to think objectively about what can ail a country and try and come up with a clear diagnosis. And I think we have to make more efforts on that front if we want to bring everyone along towards more radical solutions if those are deemed necessary, as Jacob said. So our fund advice, not in the radical domain, obviously. We are also part of the community of central bankers. And it's very similar to what Fabrizio has presented. We do believe that sovereign QE is necessary if low inflation persists. We think a more accommodative fiscal stance is called for. There is room. We've been pushing for more investment in countries that are close to their MTOs, particularly in the surplus economies like Germany, Article 4s. We are also pushing for using the flexibility that is within the SGP in those countries that are not at their MTOs. And of course, European investment initiatives, and here we welcome the Juncker plan again. If it is to make a big difference, then it will have to be implemented very soon. Structural reforms, and of course, more progress with respect to monetary union. I mean, on all of these fronts, many measures have been undertaken, but there are further steps necessary if we want to do better than what's in our medium-term forecasts right now. Thank you.
Thank you very much, Jörg. Well, these were at least radical questions. The next speaker is Paulo Mauro, whom I do not believe have a PowerPoint, but since the last speaker Angel has, we will continue this rotation. Paulo?
Thank you very much, Jacob. Good morning. So Fred Bergsten this morning started with an analogy of the euro area to a teenager. And as the father of teenagers, I was very intrigued by that. And the turbulence aspect of a teenager certainly resonates. We've certainly seen a lot of that. The big difference is that I feel that my teenagers are growing too fast. And unfortunately, the euro area is growing way too slowly. In fact, I believe that the euro area is at risk of secular stagnation. I don't have a PowerPoint, but I do want to advertise a Peterson briefing. Maybe we can do that more generally on rebuilding Europe's common future, which has been edited by Adam Posen and Angel Ubide, and several of us at the Institute have contributed to that. So certainly I would encourage people to take a look at that. The figures that I find striking are that real GDP in the euro area in 2015 is projected to be essentially at the same level as in 2008. Even more striking is the differences across countries. And Germany sort of looks like it's beginning to grow, perhaps by 1% in 2015. Lots of question marks there in my mind. At the opposite end of the spectrum, we have a country like Italy, where real GDP in levels in 2015 is projected at exactly the same level as 2001. So that's clearly quite tragic. Recent news, we've seen the decline in oil prices. That can help because of its direct impact. It can also help. This is a positive shock, but because of the ECB's mandate, it's going to put more pressure on the European Central Bank to provide further stimulus. However, the bad news, of course, is what we're seeing on the impact in Russia, which adds to the geopolitical problems there, and that in turn is going to mitigate the beneficial impact of oil prices. So bottom line, I think it's pretty uncertain, and I think even in cases like Germany, which are going in relative terms are doing better than others, I think there are pretty big question marks, and the risk of secular stagnation is very real. So the objective, everybody agrees, is for Europe to improve growth, improve employment, create jobs for the youth, and so on. At the same time, we don't want to sow the seeds for another crisis, and that would just undermine the initial objective. I've been tasked with speaking on the potential role for fiscal policy in providing help with regard to growth, and my bottom line is that fiscal policy can provide a potential positive role, but it doesn't provide that much. It just cannot do that much, at least not in the near term. I think you will hear a very eloquent case for more QE from Angel and others, and certainly you'll hear more on structural reforms certainly in the afternoon. I think I'm just going to talk about fiscal policy here in the near term. I'll talk about the composition of revenues and spending, and then I'll say a few words about the vision thing for Europe. So in the near term, most European economies, most euro area economies have their hands tied. And they have their hands tied not because of the fiscal compact, not because of the domestic fiscal rules. They have their hands tied because of how financial markets respond to possible fiscal stimulus. And we've seen this in 2012. You know, we heard a lot of discussion in the summer on making the fiscal compact more flexible and so on. And I think that kind of discussion is very counterproductive. I think that the existing architecture of the fiscal compact and the domestic constitutional amendments that enshrine in domestic law the need to go towards structural fiscal balance, I think that's exactly the kind of thing that reduces the likelihood of self-fulfilling runs on public debt. And we're seeing tremendous benefits from low interest rates right now. Just to take the most extreme case, if you look at the case of Italy, in 2015, there will be rollover of public debt by an amount equivalent to about a quarter of GDP. And the same thing in 2016. These are tremendous savings on the interest bill that are going to provide breathing room to Italy, to Spain, to Portugal in large amounts. And this is an advantage that cannot be squandered with generic discussions about getting rid of fiscal rules. That said, there are some countries in the euro area, few countries in the euro area that are in a very enviable position. And in terms of the large economies in the euro area, it's pretty much just Germany, where we have interest rates at 1%. We have fiscal balance, both in headline and in structural terms. And the debt to GDP ratio is projected to reach 60% by 2019. So here there is some room for fiscal stimulus, consistent with the domestic fiscal rules. And I think it would be in the domestic interest of Germany, given the uncertainty of the recovery and the weak growth rate, it certainly would be in the domestic interest of Germany to provide a moderate amount of fiscal stimulus in the order of perhaps 0.5% of GDP. Beyond that, if the situation were to deteriorate further, I think it would be quite reasonable to call on the severe economic downturn clause in the euro area. And as you know, the technical definition of that includes an accumulated loss of output during a protracted period of very low growth relative to potential. And that's exactly what we have seen. Again, GDP in 2015 is going to be the same as in 2008. So I think that clearly meets the definition of a severe downturn. Some people say, well, we haven't called on that clause yet. Why should we do it now? Well, it's because it's a protracted period of low growth. In fact, it's going to be by even one more year, more protracted. I would like to come back in the general discussion to the comparison that Jörg very appropriately drew between the degree of tightening in the United States and the degree of tightening in Europe. At this point, let me just remind ourselves that the level of the deficit in the United States is still of the order of 5%. So in terms of the levels, there's a very big difference there. But let's come back to the general discussion. I believe the composition of revenues and the composition of expenditures is something where we can do a lot of work and get good benefits in the medium term in terms of more growth. Perhaps even in the near term, this can provide some welcome credibility effects. On the revenue side, I think it's pretty clear in terms of the profession of economists. Most European countries overtax labor and they undertax property. Very concretely, the first thing to do would be to reduce Social Security contributions for the youth. On the expenditure side, I think the very first thing to do is to generalize spending reviews. And I think historically a very successful example of spending reviews is that of Canada, where in the 1990s, Canada undertook a really a team effort where they looked very broadly to figure out which items are worth keeping and which items should go, how can we streamline our spending. In the case of Italy, that initiative has been taken. In fact, we have the commissioner who did that review very professionally. I think now we are at the stage where the findings need to be implemented, and the political process has to take place in order to bring those to reality. You've heard general agreement that public infrastructure investment has declined, and now is the time to revive it. My thinking here is look at the case of the United Kingdom in the 1990s, where public infrastructure investment declined, and then all of a sudden people realized that that had to be reversed because the infrastructure was not up to standard anymore. So from a macro perspective, this is the time to do it. Interest rates are so low, it is obviously a great opportunity. But let's start with maintenance investment, because maintenance investment is quick, it's job creating, and you reduce the risk of white elephants being created. Then other things can come when we are sure that it's money well spent. Let me conclude with just a couple of words on the vision thing. I think that European policymakers have been on the defensive for a very long time. The agenda has been dictated by the media, it has been dictated by financial markets, by the crisis. That has driven the rhetoric and the agenda. I think it's time for the European policymakers to regain the initiative, and the way to do so is simply to reaffirm a political commitment to greater European integration, announce some lofty objectives, such as United States of Europe by the middle of the century, and then accompany that with some more concrete initiatives. Good progress has been made on the banking union. In the fiscal area, there are proposals out there for European bonds to be issued. And I think those would only be credible to the extent that the European authorities have real power to collect revenues and to make spending decisions with the approval of the democratically elected European Parliament. Now, what types of revenues could lend themselves to this? One possibility would be a truly common European value-added tax. As you know, there's been a lot of fraud, a lot of paperwork associated with the way that the VAT works within Europe at this time. Going to a European system would certainly reduce those problems, and it would provide a reasonable revenue base. Now, this is just an example. The point is simply to sort of regain the initiative, and I think in the near term, we're talking about providing the small degree of fiscal stimulus that is allowed under the existing rules, which should not be changed. In the medium term, we're talking about improving the composition of revenues and expenditures, and then renew a commitment to a more integrated Europe. This combination would provide more confidence and hopefully help to restore investment and job creation.
Well, thank you very much, Paolo. That was certainly, to my ears, a fairly radical proposal for significant further integration of political and fiscal institutions in Europe to get out of the current malaise. The last speaker on this panel is Angel Ubide, who is not part of the central banking community, but rather, I believe, at least has a past in the shadow central banking community, and therefore should not shy away from making some more radical monetary policy solutions. Angel? We should just, can we get the PowerPoint to come down?
Will it? Well, while we get the PowerPoint going, okay, it's coming. So good morning, and It's a pleasure to be here, and thank you to the Italian government for making this event possible. I just came back from China, from giving a presentation to SAFE, to the managers of their 4 trillion of reserves, precisely about Europe. And I can tell you that after I spoke for about half an hour, I got 2 questions. The 2 questions were, is Europe the next Japan? And is Europe the next Japan? And it worried me because either I didn't reply to the first one properly, or there is a very entrenched view out there that the way the euro area is going is not really the right one. So what I'm going to do once we get the slides up there is to try to present to you a little bit the ideas that are in this Peterson briefing paper that Paolo has mentioned, where we essentially try to convey the idea that something needs to change. When we were debating what the title should be saying, I think what we wanted to convey is that the status quo is not an option, that going back to 2007 is not an option either, and that in order to go back to something that is sustainable and deliver some future, there needs to be more integration and more working together. And that the policy mix and the policy setting that has been used in the last 5 years, 6 years, essentially has failed. We can justify why it happened, we can explain why it happened, we can have different views whether it was the right or the wrong thing, but I think 5 years into the process we can conclude that thing hasn't been going too well. So for those of you who don't know, this is the briefing. You have paper copies outside. You can download it from the website. And we hope you will like it and you will send out all the comments that you have. So let me just make clear what I was just trying to say. In some sense, if you think secular stagnation essentially means you keep policy tighter than it should be, or you keep the interest rate higher than what should be the neutral interest rate, that has been the design of economic policies in the euro area in the last 5 years, right? And it's because there was the wrong sequencing of policies. So there was a sort of fiscal and monetary tightening happening at the same time, which is different from what happened in the US, where there was first a monetary easing, and then eventually came the fiscal tightening, as I think George was showing to us. There was what we think, and I think experience is telling us, a bit of the wrong approach to reform. There was too much focus on internal devaluation, in our view. And this comes from a diagnostic that came from the very beginning, that this was a balance of payment crisis, that it was due to the divergence in unit labor cost, and essentially focusing reform, just to make it very simple, on wage cuts. And that has delivered a lot of pain for little gain. There has been too much focus on moral hazard and not enough focus on boosting competitiveness from productivity, and we think that that's something that needs to change. There has been too much focus on the needs of the North and too much focus on punishing the South. And I think that has to be said, and I think it's important that we pass that page and we move on and look at the future. Now, at the end of the day, the initial diagnostic was this was a problem of supply. We need to do reforms, countries will gain competitiveness, everything will be okay. What we have seen is that all the revisions have been to lower growth and lower inflation. That means it's a demand problem. There is also supply, of course. You can always get fitter by going to the gym. But what has happened here has been mostly a problem of insufficiency of demand. And I think this is the conclusion after 5 years. And this, you know, if we had to start from today, this is what we need to do. There is inertia, there is legacy, there are issues. But I think it's very important that we come to this conclusion. So just to show the same chart in a different way of what has been said. Just look at the line for the US, which is yellow, and the line of Europe, which is blue. And what you realize is that the US had a level shock, and it has gone back sort of to the same growth rate. What you see in Europe is that you have a level shock, and then your growth rate flattens. And that's the difference, right? So that indicates to you, you can call it type 1 or type 2 of crisis, but I think that's the problem. Whether it's going to be a lost decade or not, it doesn't really matter. What matters, I think, is the diagnosis. The CPR in London argues that the recession that started in 2011 hasn't ended yet. It's debatable, but if it's true, it would be a 3 or 4 year long recession, and that's too painful. So what is the outcome? I'm supposed to talk about a bit monetary policy because I was a founding member of the shadow European Central Bank. So I think the outcome is price instability, right? If I were a central banker, that's a chart I've been putting over the last year. That essentially shows you the term structure of inflation swaps. So 1 year inflation in 1 year, in 2 years, in 3 years, in 4 years. The blue line keeps on going down every time I update that chart. And that's what worries me. It can go down in the first couple of years because oil prices are lower and everything else. It should never go down at the end. What essentially markets are telling you is they do not expect the European Central Bank to deliver inflation at 2% for the next 9 years. And that's too long, unless you believe that your definition of price stability, it's okay with inflation at around 1.5 or 1.6, which is debatable, and that is something that I'm going to argue is not right. So what we recommend in this briefing, or I recommend at least, is that the ECB should ease policy aggressively, and it should do two things. One is to clarify what the definition of price stability is in the euro area. And I think that close but below 2% is just not right. It's not right because it's not well defined. It allows for interpretation. It allows for different governors with different incentive picking and choosing. And I think it essentially could be responsible in part for why those inflation expectations are not well anchored. And then, obviously, it should do aggressive easing. It should start a process of quantitative easing. I would like it to be open-ended. Open-ended in the sense that however you define it, be a monthly amount of purchases or be a total amount of purchase over a period of time, it is made explicitly contingent on being able to forecast 2% inflation over 2 or 3 years. And that's the way you regain credibility, by putting your money where your mouth is, essentially. If you look at the ECB's stance of policy, I just put this for the central bank watchers in the room. That's essentially a policy reaction function that is estimated to more or less fit what the ECB was doing prior to the crisis. And then it's projected under 3 different assumptions. The yellow line assumes that the neutral interest rate has stayed at 2, and the Nairo has stayed at around 7.75. So basically, there has been no structural damage to the European economy. That would tell you that rates right now should be around minus 2%. The blue line assumes that the neutral interest rate has gone to 0 and the Nairo has gone up to 9%. So there has been some structural damage. That would tell you rates should be at around minus 2.5%. Then you have the orange line. So what I did was to get into the econometric fancy work and estimate the Laubach-Williams model for the euro area, which is a way of basically estimating the neutral rate. It gives me minus 1.5. If you assume minus 1.5 for the neutral rate and the Nairo at around 9, tells you rates today should be at around minus 4. Now, if you think that's very low, the number for the Fed around 2010 was between minus 4 and minus 5. So not only this is not an exaggeration, this tells you that basically the ECB is where the Fed was around 2010. Now, we learned yesterday that the Fed doesn't plan to raise rates until 2015, middle of next year. So that would be 5 years of rates at 0. And there has been a lot of QE in between. So as I was telling my Chinese audience last week, you can extrapolate this and assume the ECB is going to be doing QE for the next 3 or 4 years, and rates are going to be 0 in the euro area until the next decade. And I don't think you are exaggerating. You are simply assuming that we are going to basically play in the euro area the same thing we played in the US in the last few years. So I think the main message, again, if we go back to a little bit the big picture, is that we need to change the status quo. So let me be a little bit provocative here. The economic structures for economic policy for the euro area were created for a world that doesn't exist, right? They were created for a great moderation. When they were created in 97, 98, we were expecting great moderation, inflation at 2%, growth at potential, interest rates positive. So you use monetary policy for cyclical stabilization, and you use fiscal policy simply to converge towards a balanced budget and take care of the long-term demographic problem. Well, that world doesn't exist today, and it's not likely to exist over the next 5 or 10 years. So if you had to define the rules from scratch today, maybe you will do them differently. And you will try to get rid of this asymmetry that I think exists in fiscal policy. Because when you took the fiscal compact at face value, you can only reduce deficits. It's very difficult to argue you can increase them if you need to stabilize the cycle. And it's impossible to define the fiscal policy stance for the whole of the euro area, because the fiscal compact is defined for the member states, not for the euro area. And so that is something that perhaps needs to be revisited as our leaders meet in Brussels and in other places. The second point is about reform. I think there is a bubble in the word reform. There is too much talk about reforms. People talk about reforms in abstract, and people don't know what reforms mean. Our colleague Nicolas Veron tells this joke that there is this cartoon of François Hollande and Angela Merkel meeting, and François Hollande tells Angela Merkel, the French people are terrified of all these reforms. Angela said, but which ones? Oh, the ones in Greece and in Italy and in Spain, right? I know the joke is not very good, but it tells you an idea that when you talk about reforms in abstract, you get no benefit, but you get the fear and the uncertainty about what things may change. So here is an alternative. Each country picks a binding constraint. They define what's the reform they need to put in place to make their potential growth higher, and commits to it. And that implies taking ownership of the reform process with a very clear objective and a timetable. And we think that that is something that could deliver a better outcome and could boost investment after all, because then you would get economic agents knowing with some certainty what is happening. The final point is that there is a need to complete EMU via Eurobonds. I think Paolo was very clear about that. I think the point is this. If there is another shock and fiscal policy has to be proactive again, I don't know if the euro area is going to be, if fiscal policy needs to be pro-cyclical, in other words, it needs to be tightened when there is a recession, I don't know if the euro area is going to be able to survive it. So I think it is important that this is taken seriously again. And here comes my final point. This cannot be done on a weekend. You cannot wait for the next crisis to get this done. So the reason we did this brief is essentially because there is a new leadership in Europe that starts essentially now. There is a new European Parliament, there is a new Commission, and there is a new President of the European Council. You have a 5-year period now to create the basis for a more sustainable euro area. Now, when you are not in a crisis, it's a very dangerous moment, because policymakers don't have any incentive to change anything, right? They don't go out on the window and they see the fire out there. And that's when we, economists and everybody else, need to try to make this as clear as that. We need to change what Adam Posen and myself call in the introductory piece the economic Versailles. Stop punishing. We need to move on. Yes, there were things that needed to be punished, but it's time to move up. It's time to go to a policy mix that leads to recovery. Because the alternative is going to be twofold, right? If you live in Spain and you look at Podemos, and you don't know where they come from, you say, these guys make a lot of sense. And that's the problem. There is a lot of people from the right and from the left who are essentially saying, the current government is not offering me what we need. There is a lot of unemployed people out there, and all they talk about is more fiscal tightening. And that is the problem. The rise of the Euroscepticism, the separatists, the populists is coming from there. Jacob was just coming, he was telling me, from a hearing on debt restructuring in Portugal. This is happening, this is part of the program of Podemos, it's part of the program of Syriza. There are many people out there who think debt levels are too high, the only way out is to restructure the debt. Well, if we don't deliver nominal growth, so if we don't change the policy mix, that's where we are going to end up in a few years if the kind of projection that Jörg was suggesting about nominal GDP per capita growth materializes. So I think this is a risk that we need to take very seriously. The leaders need to take a medium-term view, and in our view, they have to start doing it now. Thank you.
If I could invite the other three speakers to come up here to the podium, we can start the more interactive phase. And I guess I will misuse my prerogative as chair to ask at least the first question. And I would also do it, and I'm sure I will preempt another question, because Adam is not here, but Fred is here. And this is the Peterson Institute, but the word exchange rate didn't really come up very much so far in this presentation. But one of the things I was struck by when Peter Pret was here speaking to us last week was that he mentioned a couple of times that one of the ways in which the ECB could implement quantitative easing that included purchases of sovereign bonds would be to purchase solely the AAA rated segments of that. It would seem to me that that is something that would really only have one intention, which would be to drive down the value of the exchange rate of the euro. So my question to the panel would be, personally, I'm skeptical that the exchange rate is much of a sort of silver bullet for the euro, and it has much of an effect. Is this something that, even if you obviously cannot in the official circles articulate it, but is it something, should it be used as an operational policy tool? Does it have any real impact?
You want an answer? I mean, I can give you my view that, so when you look at equilibrium exchange rate models, I think what comes out is that the euro is at around equilibrium. Does it make sense to think that it's time now for the euro to be below equilibrium for a while? I would say yes, given the divergence in the outlook that we are seeing here. Is that going to make a big difference in terms of growth? I don't know. I'm less sure, but why not?
Okay, I should say that there is a mic in the back, and there is a traveling mic here as well. But while people line up, the gentleman in the back.
Hi, Mike Prell. I'm an independent consultant. I guess I'd like to address a question to Angel, partly prompted by thinking about what Chair Yellen at the Fed said yesterday about the criterion for tightening policy involving, in essence, a credible forecast of inflation moving to 2%. And I'm wondering, in your prescription, what makes a forecast credible? In looking at the fuller text that you've prepared, you refer to an overshooting of 2% as being perhaps an inherent part of that formulation of a credible outlook of 2% inflation. I'm wondering whether, as you were writing, you weren't also thinking along the lines of possibly going to a price level target, but for some reason might have decided to back off from that. So I'm wondering if you could flesh out your thinking on these points.
I think what makes a forecast credible is two things, right? One is that you manage to push long-term inflation expectations back up to that target or to that forecast, to the desired level. And second, that you have a credible growth forecast that is going to have a credible closing of output gaps and other things. And I think those are the two key elements. I don't think we have them today. And I think the ECB is transparent and explicit enough when they talk and with the projections that they put in place that this could be achieved. It's just a question of putting in place the right policy in order for all of us collectively to believe that the growth forecast can improve and that their determination to hit an inflation of 2% over the medium term is there. And then I think it will work.
Is there anybody else on the panel who would like to address that issue?
Just a couple of words, perhaps. The tone of the debate seems to be assuming that the ECB and the Governing Council are not willing to take the kind of action we've been discussing. It seems to me that, as Angel just said, the ECB has been pretty outspoken that there are deep concerns about the price developments in the area. And both the President and other members of the Governing Council made it clear that that the situation is being monitored closely, and if need be, they are prepared to take the action that was being suggested earlier on, that is the QE. So I would be less, I would give a more balanced view of what the policy position of the ECB currently is.
Krishna?
Thanks, Jacob. Krishna Guha with Evercore ISI, formerly New York Fed. So I agreed with an awful lot of what was said in the discussion previously. I'm, in particular, the need to address some of the medium-term institutional architectural questions that allow you to coordinate to better policy mixes and reduce some of the vulnerabilities. But let me focus on monetary policy. So it seems to me that as I anticipate we move into a QE, full-bore QE phase in January, ex post, this is going to be open-ended QE. It would be incredibly helpful if ex ante it was also open-ended QE. In other words, the ECB will, after the fact, end up having to keep buying assets, whether it's in a stop-start QE1, QE2, QE3 environment, or whether it's in an open-ended program. I think it'd be far more effective if it's open-ended from the get-go to get more traction on expectations. But I wanted to pick up on actually a point that the previous questioner raised, which was I was going to ask. If we're in the business of more radical solutions, at least those of us aren't currently in any kind of office, it seems to me that actually there's a very strong intellectual case right now for the ECB adopting a price level target. If you're going to revisit the definition, and I agree that it's unfortunately a la carte at the moment how you interpret the current inflation target, strong case for moving to a price level target would essentially would commit you to catching up on the inflation shortfalls. This would allow you to bend sort of medium-term inflation expectations up while anchoring the longer run expected inflation. Of course, for debt sustainability and so forth, what matters is the evolution of the price level over time, not the annual inflation rate. So in the spirit of putting out more aggressive suggestions, I know not ones that are necessarily achievable in the next quarter, next 2 quarters, what are the panelists' thoughts about the economic merits of a price level target, which could be defined as 2% rolling, or indeed even 1.75, 1.8, something fully consistent with past ECB inflation performance pre-crisis?
If we're just thinking about price level targeting versus inflation targeting in the complete abstract outside the euro area, right? Let's say it was just any other country. I would say, the literature suggests that you have more anchored inflation expectations and more price stability with a price level target, right? So the purely intellectual case for moving to a price level targeting is pretty strong. Now, let's bring it back into the real world, the euro area. You have to ask yourself the question, is the inflation target, the way the ECB has adopted it, a constraint, a binding constraint on its action right now, next year, the year after next year? My sense is no, that is not the constraint on its action. The constraints are elsewhere. So the issue is not that the ECB cannot talk the talk. It is about it being able to walk the walk. And on that front, I would go back to something I said before. I mean, there are still different diagnoses about what's ailing Europe out there. That's number one. And number two, there are significant disagreements in terms of the effectiveness of QE. And these are areas where I think we need to contribute a bit more. Let me just add one more thing on the first question, which was buying only AAA. I don't want to answer the question that you raised, but something else, which is whatever the ECB will do, whichever way it implements QE, and that's, I think, what you hinted at, Krishna. will very, very importantly determine its effectiveness. It's absolutely critical. I mean, you know, if the ECB was to come out, you know, and say it was only going to purchase AAA assets, it would send a very powerful signal in a very specific direction. Relative to a scenario where it would come out and say it purchases all sovereign assets as a function of the capital key, right? I mean, these would send very different signals. I think the way if it does move to QE, the way it will do it will be absolutely critical for its effectiveness. And I totally agree with what you said on that front.
Anybody else? Yeah.
Yeah. I just want to add that there is another issue in Europe which is not specific to monetary policy, but concerns the whole economic governance setup, and that is the difficulty to arrive at the shared interpretation of the rules. You've seen these in the discussion of fiscal policy earlier on. We were mentioning the margins of flexibility in the SGP. 3 out of 4 speakers talked about it, and we used all different words. They were just nuances, but behind these nuances there is substantive disagreement, at least the potential for it, and certainly in Europe there is disagreement. Concerning monetary policy is a bit the same thing. It's not really a matter of what is the target. It's how do you read the constraints, the institutional constraints on the possibility of action for the governing council.
Okay, next question, the lady.
Yes, my name is Annette Dekkers. I'm from the Dutch embassy here in town. My question is on the structural policies, and I would like to hear from the panel what room they see at the European level, policy room, to have European structural policies. And I'm thinking at, for instance, the capital market union. One of the differences between the US and the EU, as I learned, is that in the shock absorption, there's a very big difference in the role of the capital markets. I think on labor mobility, I think on, we are looking at investments in Europe, also in cross-border infrastructure. How could you add to that with regulations at the EU level and that sort of policies? And if I may also have a comment, I don't believe that, like in the last few years, we had too much of a structural policy, that's, say, the main problem in Europe. I think that, at least in my own country, in the Netherlands, that we had postponed several things that we should have done, and that in 2012 we went to do them, and we were very happy that the European Commission allowed us some flexibility on achieving our deficit, so that we could also design the structural policies. And I'm thinking about the housing market with the, we have a mortgage rate, interest rate reduction, for instance, there. I'm thinking of the labor market, the pension reform, that we had some time to design those with a view to the long term. But my question is basically on structural policies at the European level.
I should say that we have our entire afternoon panel on structural policies, but if there are anybody on the panel who wishes to comment on this, you should feel free to do so now.
We're very much in agreement on this. I mean, one of the reasons why the European economy has had bigger trouble getting out of this recession relative to the US economy is that it is an economy that financially flies on mainly one engine, banks, right? While the US flies half on banks, half on capital markets. And so there's an urgent need to develop Europe's capital markets. I think the need has been recognized now also at the EU level. The question is, how do we get it done? It's very complicated. Many things then go down to such issues as insolvency, reforming insolvency laws, you know, coming to a common framework for insolvency and issues like that are very complicated. In the past, the way to move forward has been through directives, right? That's the European reform way, but directives are then often interpreted differently across countries. Maybe there's another way to proceed here, more akin to what's been done with respect to the banking union, where the process has been driven by a legislative agenda, and where really important achievements have been had over the last year. The other area which is very important for reforms is, of course, product markets, where there's a lot of room still to integrate Europe and get to more competition. So I very much agree that there's a big agenda, a pan-European agenda out there. Paolo?
Sure. Well, first of all, let me again point to the chapter in the briefing that was done by Nicolas Véran on the topic of capital markets union. I think that's probably the best thing to look at. But certainly the European Union institutions have not been shy, as Jörg was mentioning. There are vehicles there, so some things can be imposed through a centralized process in terms of reforms. But also, as Angel was saying earlier, some of the key reforms are actually quite country-specific, and those can be done by individual countries. I mean, if I had to look at the case of Italy, I would point to the speed of the justice system, which may not be an issue in other countries. So certainly there's a lot of scope for very important structural reforms that can take place domestically and can be originated domestically as well.
Angel, did you have one?
Yeah. Let me just clarify in case I wasn't clear. I didn't try to say there has been too much reform or too much. There might have been too much emphasis on reforms only, and that may have got in the way of having a more complete package that included also demand policies to support these reforms. There may have been too much focus on a specific type of reforms that were focused on internal devaluation in some specific countries at a time when those countries were suffering a very sharp negative demand shock. And then I think one can push the envelope, right? There are reforms I would have liked to see that I didn't see. For example, that when there was a banking union, there would have been through European bank recapitalization. That would have been a structural reform of the euro area that would have been incredibly positive if after the 2012 G20 meeting there had been a clear commitment to European bank recapitalization, rather than deciding that bank recapitalization was going to be done at the national level. Or if at the time they would have been put in place a process to the creation of Eurobonds, even if it was a 5 or 10-year process. So there were many reforms to be taken, many reforms to be adopted. I think one can be critical of the type of reforms that were chosen and picked at the time. And I think that's the kind of message that we want to say. There can always be more reform that makes you better off, definitely.
Fabrizio?
Yeah, a word of caution on the banking union. It's certainly a great progress, but it is just a first step, I think, in the road to a truly unified financial market in Europe. I mean, we have now a common supervisor, and we have defined common standards for supervision, but the underlying legal systems in the member states are still different. So there is a lot of work to be done there. So we shouldn't be too complacent on what has been achieved and look to the future, having in mind that there is a lot of work to be done in the pipeline. Another thing on structural reform in countries, in individual countries, Italy is an example. I mean, Italy's been making reforms over the last 10 years. Not very often we get a lot of recognition for what has been achieved. One example that comes to mind is pension reforms. Italy has been reforming pensions since the early 90s. The result of the reforms were showing up in fiscal sustainability indicators, yet over the years in international fora, my experience is I kept receiving questions about what and how Italy was planning to do to face the demographic challenge. And so clearly there wasn't recognition of that. Let me also say that there is a lot of work to be done on the structural front in Italy. Mention was made of the efficiency of the judicial system. I would also think about the labor market. But on all these counts, work has been underway. A first wave of reforms, significant ones, has been taken by the last 3 governments we had. Work is ongoing now. Perhaps the fact that we have that many governments also plays against us, in the sense that every time there is a new government, the sensation around is that everything has to be started from scratch, whereas there is a lot that has already been done, so we can build up on that. Finally, on Europe, national or European reforms. I think the main obstacle to European reforms is that we have to build Europe first, the euro area first. There is a lot missing there. When there is a call for a stronger and deeper and more genuine union, that I guess that is what we are saying. We lack a European government, we lack a European budget, so without that we cannot do much. But again, I think also with respect to the euro area, sometimes the enormous progresses made over these very difficult years are sometimes overlooked. When the crisis erupted, Europe did not even have a system to manage financial crisis. Actually, management of financial crisis was simply ruled out by the treaty. We have come a long way. Unfortunately, no matter the speed of reform we are taking, the events seem to outpace us. But I think we can be resilient.
Paolo, final comment?
One final bit of shameless self-advertising on this very point that Fabrizio just made on how the sustainability of the public finances differs, whether you look at the headline debt to GDP ratio or whether you also include spending on pensions and healthcare that is coming the next decades. We're just posting a blog entry on that with some charts that show how the picture changes dramatically if you start including pensions and healthcare. And indeed, Italy looks very good on that. And I'm afraid that, like the United States, the Netherlands looks very, very bad on that front. So it's interesting to see how the picture changes. And we just show the data.
Bill? Bill?
I'd like to make an observation and then raise a question. The observation is very important to think about the demographic trends when one thinks about growth performance. If you take the population that is of the prime working age, 20 to 55, as your denominator, both Germany and Japan have had better economic performance from 2000 to 2014 than the United States. You do that calculation, that's the result you get. So as you draw these graphs about how Europe has just sort of stagnated and the US has grown, and you look forward, it's very important to think about what the demographics are. And Europe's working age labor force is declining much more rapidly. The US working age population is still rising, although not as fast as before. Secondly, I'd like to highlight what I think is a somewhat different viewpoint among the panel and see if I can bring it out. Certainly, the introductory part of the Peterson briefing is very acerbic about what implies excessive fiscal restraint. It seems to be the implication. And yet, Paolo's article basically says you've got a room for about 0.5% of GDP fiscal stimulus in a few countries that have fiscal space. It seems to me that that's a fairly divergent set of viewpoints. And if, so I think it would be helpful for Fabrizio and Angel to tell us whether they agree with Paolo that there are those fairly substantial limits on the scope for further fiscal expansion.
Before you answer, I should say that the briefing is written in true Peterson Institute fashion, namely that there is no assumption of agreement among the contributing authors. I don't know who would like to start.
We do not speak with one voice.
No.
Let's make that very clear.
You want me? Okay. We don't even necessarily have to agree if we co-author a piece, but that's a different story. So I think to Bill, I don't disagree, but at the end, the debt to GDP ratio is an aggregate measure. It's not a per capita ratio, right? And so the country needs to generate enough resources to pay the debt. And if the country cannot generate the resources to pay the debt, then it needs more people. But no, all I'm trying to say is that I agree that on some per capita basis, one can argue that, for example, Japan has done quite well and deflation wasn't an issue, but at the end of the day, when you look at the debt dynamics, they are a macro measure, and that's where I really worry. Now, I wouldn't worry too much about the debt dynamics in the euro area if there was a political commitment not to treat the debt of each individual country as the debt of each individual country, right? If we had a European debt, then 90% debt to GDP ratio is not a big deal, especially when you are going to spend a fair amount of time, in my view, with long-term interest rates that are going to be very low, because that's what monetary policy needs to do in order to achieve the inflation target. So I think everything is conditional on the kind of a structure that you want to have. And that's where I link it to the second question. So is there fiscal space? Yes, if you make it. I worry less maybe than Paolo about the market reaction to suspending, if you want, the fiscal compact, if that is done in combination with aggressive monetary policy. Now, we can agree or disagree whether that's the right policy mix, whether that could create the right or the wrong incentives, but I think a space is in the eyes of the beholder, and there could be a space if there is an agreement that what you need to do is a much more expansionary economic policy. And economic policy can include monetary and fiscal. It doesn't have to restrict itself to just one of them.
Yeah. To answer to the second part of the question, I think we need to go back to 2011 and the burst of the sovereign debt crisis, and to recognize that that was really an emergency. It was a situation in which yield differentials among government bonds in Europe widened sharply, but the main reason why they widened, at least in many of the countries, it was the fear of a possible euro breakup. We estimated at that time that out of 550 basis points of differential between the Italian and the German 10-year sovereign bond, out of 550, 350 were due to this fear of a breakup. So only 200 were reflecting the, so to speak, the economic fundamentals. And I think that at that stage there was little choice but to try to reassure the markets and, as I said in my opening remarks, to rebuild also confidence among the member states. Now, after 3 years, we have gone through deep reforms at both the European level and the national level. And I think that now we have the fiscal space, we have the room to fully implement the rules that we have given ourselves. There is no need to suspend, if I may correct you at the margin angle, the fiscal compact or the SGP, because within those two pieces of legislation, so to speak, there is already room enough for flexibility to be granted to individual countries. And in order to make this fiscal space, we may go the long way towards a common fiscal capacity, or we may anticipate the things a little bit by having a coordinated action. What I mean by this is that if any action by individual member states comes under the cover of a European umbrella, which states that these actions are consistent with the rules that are done within a coherent framework of fiscal policy expansion, then I think we have the space in all countries. Of course, the degree to which this space is available is going to be different for Italy and for Germany, but I think it can be there for both.
Maybe one comment. I mean, one issue we still have with the rules-based framework is it doesn't cover one part, which is the coordination part. I mean, the idea was always if you had a national shock, you dealt with it with fiscal policy, and if you had a euro area shock, you dealt with it with monetary policy. But if monetary policy hits the zero lower bound, right, or is deemed not to be a very effective tool anymore, then suddenly, if you have a European-wide problem, the fiscal comes to the foreground, and there is this need to coordinate, and that's a little bit something that is still missing. Something like, you know, the euro area fiscal stance. It doesn't really exist, and it's something that, however, policymakers need to think about now.
All right, I have 5 people on the list and about 7 or 8 minutes left before lunch. So I'm going to have to ask the remaining questionnaires to be relatively brief. And then we're probably also going to have 2 questions together. So first Fred, and if I can ask Ben to go up to the standing mic afterwards.
I just wanted to come back briefly to Jacob's original question about the exchange rate, but put it in a different way. Jacob kind of talked about it as a policy instrument with the ECB looking perhaps to use it as a main transmission belt for monetary policy. Let me put it more neutrally. If Angel is right, or anything like right, that ECB rates are going to continue at 0 into the next decade, 5 years or so, and over that same period, reasonable to believe that the Fed might be able to normalize, at least to a large extent, from where it is now, thinking 5 years out, shouldn't we simply, as a matter of prediction, expect a huge depreciation of the euro against the dollar, but trade-weighted as well? I mean, the euro went to 1-to-1 against the dollar in its early years. Why shouldn't we expect it to go back there? If that's the case, if there's a really big move in the euro, does Angel want to reconsider whether, maybe it's not a silver bullet, but whether it might have quite a big effect in altering the growth outlook, as well as maybe achieving the inflation target, which would be its primary objective?
Ben?
Thanks. I was just hoping that the panelists could
Could you please identify yourself?
Sorry, Ben Carliner from the EU delegation. Could you address the role of financial regulations in keeping investment down in the euro area? And because it seems to me that one of the reasons behind the decline in the ECB balance sheet and bank balance sheets more generally was that people were preparing for the AQR. Now that that's over, to what extent can we expect that constraint to go away, or is it going to continue to constrain the ECB's monetary policy goals, particularly with regard to the TLTRO and the ABS purchases? Thank you.
I don't know who on the panel would like to start with either of the 2 questions.
Let me just, by the way, when I say rates at 0 over the next 5 years, it's basically priced in the markets. So the 5-year Ionia rate is roughly 0. I mean, there is a little bit of risk premium there, but I don't think I'm saying anything here that is very different from what markets are pricing. So just 2 quick comments. I don't think you don't achieve inflation credibility with the currency, right? Because you would need a permanently depreciating currency. So no, it will help, in the near term if you want with headline inflation and all that. But I don't think monetary policy should be counting on the exchange rate to solve the problem. And as far as growth, the reason I said I don't really know is because I look at the counterfactual, and I've seen the yen depreciating 40% and having no impact on exports in Japan. And so I'm simply wondering whether the structure of international trade and multinational companies has changed, and the currency is much less important for growth than it used to be, on the downside and on the upside. This would apply also the mirror image of what the impact would be on the US of an appreciation of the dollar. So I'm just skeptical, because we have seen these other examples, and I don't really have a good explanation for them.
I wanted to come back to Bill Klein's question, which I thought was very, very useful, and just complement something that Angel mentioned. Bill essentially said, look, if you take into account the demographics, then Germany and Japan don't look as bad as if you ignore them. And I think it's important that we take into account the fact that ultimately what matters for that sustainability is overall growth, not per capita growth. But the thing I want to add here is that the ability of the US to attract people and to bring in immigration and have it be a fruitful contribution to the economy is something that certainly has helped it. And that's something where other countries should learn. Certainly, if you think about the staggering changes in demographic projections around the world, we know there's going to be an enormous demographic explosion in Africa, for example. I mean, that could be a huge opportunity if Europe or other economies were able to capitalize on that to bring in people and contribute fruitfully to their economies. That would help. That would help in the very long run fiscal projections for sure. On Fred's question, I think that's a very stimulating question. I'm sure we'll have lengthy internal and possibly external debates on that for a while. But my sense is that it's important that we also look at what happens to the economic cycle and how that determines the current account. And we need to think more broadly about savings and investment, because I think those would make would complicate the picture quite a bit compared to your very streamlined projection, I would say.
On the exchange rate, I think the ECB and more generally the system of European Central Bank is never tired of maintaining that the exchange rate is not a target. But we certainly agree that it is a channel through which monetary policy impulse is transmitted to the economy, so point taken. On financial regulation, yes, the preparation for the AQR and the very severe definition of the capital requirements for bank participating to the exercise may have contributed to tightening credit conditions in the area. I don't think that was the leading factor, though. We hope that now the greater transparency that is the result of this exercise will help ease the situation a little bit. However, both the results of the last TLTRO and surveys among banks and enterprises suggest that there is also a problem of demand for credit at present.
All right, I now have 3 questionnaires. They're conveniently all sat around the back mic, so if you could all please line up behind the mic. And when you ask your question, be mindful of the fact that it is now your questions that stand between everyone and lunch.
Okay. I'll be very brief. Alex Peterson with AICGS. I'll try to play the role of the ugly German, although I'm half Italian. And ask the question that has been touched by Ben, but also by others, about the different structure of financial markets in the US and in the Eurozone, and the over-reliance on banks as a transmission channel in the Eurozone, and whether the speakers, and I think this is primarily for Mr. Balassone and for Angel, whether, given the fact that the liquidity injections, TLTROs, LTROs, have so far failed to reach the real economy, and I think Bank Italia data, recent Bank Italia data also reinforce that point, because 2/3 of the take-up of TLTRO among Italian banks has landed basically towards sovereign bonds. So basically the holdings of sovereign bonds have been boosted by the TLTRO, but the real economy has not been reached. Whether you think that the different structure, capital markets based in the US and bank based in the Eurozone, is an additional constraint, even in the case of outright purchases of assets enacted by the ECB, probably starting in January or shortly thereafter. Thank you.
If I could ask the other speakers to be even briefer than that.
Hi, I'm Gonzalo Garcia from the University of Spain. it's very difficult after all these comments to be that brief. I wanted to also ask Jörg about the Capital Markets Union, because we have been hearing this for such a long time. I just read in Nicolas' article that the new commissioner wants a plan, but there was a plan for that in 1999, you know, and we've come a long way on capital markets. And when I listen to the panel on this, I have the feeling that we run the risk of having to do everything from scratch and with no regard to what we have achieved already. And I even look at Spain, where of course the banks are very important, and I see that the capital markets are already contributing to the financing of companies. Many of them are resorting to that. So why does the fund think now that we have a problem among all those problems that we have a problem with the capital markets? Because it's not just about directives. We've done regulations in all aspects of the capital market. So I'm intrigued about your comment on that. Thank you.
And Ted?
Ted Truman here at Peterson Institute for International Economics. I think I can be briefer than my two colleagues. So one question is, to what extent, and the sort of theme of all this is Europe has to go together, right? Some of us advocated this several years ago, but we're all on the outside. In particular, you could think about the fund and whether it hasn't played its role. We have 3 alumni for the fund and 1 current resident of the fund there. You know, in terms of putting pressure, requiring a euro area program rather than a Greek program, or more broadly, what role is there for the external forces, if you want to put it that way, in bringing about this kind of change in the direction of policies in Europe? Thank you.
And I think we can have a brief intervention from all the 4 panelists on whichever part they would like to address. Okay.
I'd like to address the question on long-term refinancing operations. The claim that they did not reach the real economy. Indeed, the result of the last operation, as I said already, was a bit below expectation. However, when judging the impact of this kind of operation, we should also look at the potential counterfactual. Look at the LTROs undertaken earlier on. They also had been accused of essentially providing banks with the money to buy government bonds. But what these operations made, they provided banks with the means to face large financing needs that they were going to have difficulties finding on the markets at the time of the peak of the crisis. Concerning the more recent operations, and I think there is also a bit of wait and see on the part of the banks. There is a lot of expectation that the ECB may be going to take other policy options. So maybe there is not much of a hurry in picking up funds at this stage. As to whether the structure of the market then poses a constraint on the strategy that the monetary policy can follow in Europe compared to the US, I think that rather than to the strategy, it constrains a little bit perhaps the type of assets the ECB can use for that purpose.
I pick up the questions on capital markets and on external forces in bringing about change. On capital markets, clearly capital markets in Europe have developed since 1999. Stock markets in Europe are not much smaller or of a similar size relative to the US, but the bond market is still much, much smaller. Yes, we have covered bonds, we have also securitization in various countries, but there is no pan-European approaches to these instruments. And as a whole, the volume is still much, much smaller than in the US. I would add also that on the demand side, there is still a lot more home bias within Europe than in the US, right? I mean, I guess the average Floridian, holds a very well diversified stock of US assets that are certainly mostly outside operating outside Florida, and you cannot say the same thing about people that live in Italy or in Germany or even there to some extent many of their insurance companies and so forth. I cannot tell you about the reasons in detail. I think Nicolas Véron has written up an excellent piece on this as to what needs to be done, but it is really rooted in some deep obstacles, including at the legal level. On external forces in bringing about change, well, I mean, our programs have been with countries because that's where the balance of payments constraint became binding at the European level. Europe has a current account surplus and never really had an issue. What is important, however, and there one of the lessons we've drawn about our involvements in programs in specific countries, such as Ireland. We have an ex-post evaluation that has come out, and also others. It is clear to us that as we deal with members of a currency union, we need to look beyond, in the context of our programs, beyond the problems that are country-specific, but also address the problems that may be rooted at the union level, and that is something. It's an important lesson that we have drawn.
So just quickly on credit easing and QE, and I think it's another example of how the diagnosis was a little bit unclear, right? At the end of the day, what we have realized is that there was a major problem of demand for credit, not of supply. And so some of these credit easing operations coming from the European Central Bank were well intended, but they were not necessarily addressing the key issue, that was the demand part. Now, can QE work in a bank-centric system? The answer is yes. And the channels are two and are well known. The first one is commitment. You are buying, you are putting your money where your mouth is, you are committing to hitting your target, and you are showing it with money. And the second one is portfolio rebalancing. If you are credible, you will increase inflation expectations, you will reduce real interest rates, economic agents, be it banks or investors, will buy riskier assets, will ease financial conditions, and eventually it will help to boost investment and job creation and growth. And it's just a question of trying. It has worked in other countries and it will work in the euro area. I'm sure of that.
On that note, I would like to thank the four panelists and declare the first panel over, and lunch is now served in the back, so I would encourage everyone to get up and have as much as they would like, and then after a brief interval while you sit down and have something to eat, the keynote speaker, Mr. Sacomani, will come up and make his remarks, and then there will be an opportunity to question him during your meal as well. First session over. Thank you.